Okay, we are recording. Hi there, everybody. I am doing this recorded lecture for Chapter 9. So we're going to go over, and I'm actually going to divide Chapter 9 into two different lectures because with Chapter 9, we're talking about two different inventory systems. Or two different merchandising types of systems that merchandisers can use, a periodic system and a perpetual system. So I'm just going to do one recorded lecture for the perpetual or a periodic system first, and then do a second recorded lecture for the perpetual system. But this is all Chapter 9. So we'll go over some PowerPoints and then hopefully have some time to do some of these journal entries together. So let me share my screen with you and get the PowerPoints pulled up. Get myself out of here so I don't have to stare at myself the whole time. Okay, so Chapter 9, again, we're going to kind of divide this up into two different lectures. First, I'm going to talk about sales and purchases in the periodic inventory system. That's what's discussed first in your textbook. And then we'll do a recorded lecture for sales and purchases in the perpetual inventory system, because there are some differences between the two and how we record these transactions. So Chapter 9, again, sales and purchases. And, you know, in Principles of Accounting 1, we got practice with sales transactions or, you know, purchases of, you know, assets, supplies, or prepaid insurance, whatever, you know, what have you. So we've gotten practice with some of this already, and some of this will look familiar to you. But there are some new accounts that we talk about. For example, you know, sales returns and allowances, purchase returns and allowances, freight in. So some of these other accounts that we have not discussed yet, we're getting introduced in this chapter. So merchandising businesses. So, you know, when we think about a service company versus a merchandising company versus a manufacturing company, so a service organization provides some type of service to the public. So whether it's a, you know, carpet cleaning service or, you know, a oil change service or, you know, a massage service, right? I mean, service is providing some type of service to the public, right? Or to consumers. Merchandising is when we buy goods and then resell them at a profit, hopefully, right? So merchandising, they will buy goods or products from a manufacturer or from a distributor, and then they turn around and they sell those products to consumers or to the public, hopefully for a profit, right? That's why they're in business, is for a profit. So merchandising companies, they buy goods and resell them at a profit to final consumers usually. And then manufacturers take raw materials and turn them into a finished good. So you could think about like a bicycle manufacturer, right? They take the wheels or the tires, the handlebars, the frame, the seat, right? They take all those raw materials and through the manufacturing process, turn them into a finished bicycle, turn them into a finished good, right? So that's kind of the three main types of businesses, you know, service business, merchandise business, manufacturing business. So, you know, merchandising companies can be divided up into wholesale businesses or either retail businesses. So wholesale businesses buy goods from manufacturers and then sell them to the retailers. And then the retailers sell goods directly to consumers. So just like it shows here, wholesale businesses, also known as middlemen or distributors, because they're a link between the manufacturer and whoever is selling the product to the final consumer, to the public. All right, so merchandising inventory, we can either calculate inventory based on a periodic inventory system or perpetual inventory system. We learn a lot more about this in intermediate accounting as well. But just like it shows here, periodic inventory system, we have to periodically or ever so often take physical inventory of what we have on hand and then determine what the value of that inventory is. Perpetual inventory system, the inventory system is being perpetually or continuously updated after each sale, each purchase, right? So, again, I'm going to divide chapter 9 into two recorded lectures. I'm going to do one for periodic inventory system and then one for perpetual inventory system. All right, so sales transactions, again, we've gotten some practice with sales transactions already. Remember in the past or in Principles of Accounting 1, when we got practice with some of these transactions, we would, debit accounts receivable, credit revenue, right? Those are the sales transactions that we got practice with before, right? So sales account used to record the sale of merchandise. This is our revenue account. So we could even say credit sales revenue type thing. And invoices. So the invoice for the transaction, and it shows this on page 368. But an invoice for a transaction, and I'm just going to flip there real quick to look at it. It shows like the number of units being purchased and how much we're paying per unit, the total amount due, if there are any freight charges, the invoice date. Again, it's shown on page 368. And then usually that sales invoice, copies of that sales invoice is sent to separate departments so that separate departments can kind of do their thing with it. So a copy of the sales invoice is sent to the sales department, to the accounting department, to the credit department, and then also to customers as well. So kind of multiple departments involved with a sale and kind of with the how that sale flows through the system, accounting system. All right, so here's some examples of some transactions. One thing to keep in mind that we're going to see here, and remember, like I said, when we recorded sales before, we would always, debit accounts receivable, credit revenue. And we're going to see that now, again, with these transactions on the next slide. The only difference is that, and we discussed this a little bit in Principles of Accounting, when we think about our main accounts receivable ledger account, the total balance in there is made up of individual customers that owe us, right? So when we record this, we're going to attach like a customer name also to the transaction. So we'll see that. Okay, so here are our transactions. Again, we're going to look at each one of these. So sold merchandise on account for $1,933.50 to Mesa River Raft Company. Sold merchandise on account to Green River Rafts, $1,116. Sold merchandise on account to Marty's Fly Fishing Adventures, $1,594. Sold merchandise on account to High Flying, $552.30. Sold merchandise on account, here's another one for High Flying, $1674. So again, thinking about how these transactions look, we've got the debit to accounts receivable, but now we see the name attached to it. And then we've got a credit to sales. There's our credit to sales. And again, we think about that like sales revenue. This is our revenue account, right? Sales revenue. And you'll see it's like this for each one. Just again, they have the customer name tied to it, Green River Rafts in this case. And so all of these customers, Mesa River Raft Company, Green River Rafts down here, Marty's Fly Fishing Adventures, each one of these customer accounts and what they owe add up to our total accounts receivable control account, right? So we've got our main accounts receivable control account that shows, you know, all the accounts receivables due to us. And then that accounts receivable control account is made up of the balances of all these subsidiary accounts receivable accounts. So, you know, here's one for Mesa River Raft Company, subsidiary ledger account for Green River Raft, subsidiary ledger account for Marty's Fly Fishing Adventures, right? So when we think about how to record these, and just like it tells us in our book, you know, when you enter transactions like this into accounting software, it not only updates the subsidiary account, so it not only updates Mesa River Raft Company, but it updates total accounts receivable as well, right? So we've got our main accounts receivable ledger account, and that balance in accounts receivable ledger account is made up of all of these people that owe us money, right? It's made up of those individual customers or individual subsidiary ledger accounts. All right, here's some more examples. Again, we're debiting accounts receivable for High Flying Adventures, Inc. We're crediting sales. The next one, same company, debiting accounts receivables for High Flying Adventures, Inc., crediting sales. All right. Here's what it would look like again on that, thinking about that basic accounting equation. You know, each one of these transactions would have the debit to accounts receivable. Each one of them would have the credit to sales. So you can see each one of them here, the debit to AR, the credit to sales, the debit to AR, the credit to sales, right? So on and so forth. Debit, accounts receivable, credit, and now in this one, they're calling it sales revenue. Or they're calling it sales, and I'm saying sales revenue. Okay. All right, sales returns and allowances. So we haven't used this account before. This is a new account for us. We did not discuss sales returns and allowances in Principles of Accounting 1. But basically, sales returns and allowances are for, you know, if we're a company and we're selling merchandise, like the example we just looked at, you know, we sold merchandise to 4 or 5 different customers. Well, if one of those customers returns part of that merchandise, then it would go into sales returns and allowances, right? And so what ends up happening is we take our total sales minus sales returns and allowances / allowances, and that gives us net sales, right? And so that's what it's telling us here, that this sales returns and allowances is a contra account that's deducted from sales. So to calculate, because again, you know, if we think about, say we have a customer that bought $1,000 worth of merchandise, well, then if they returned 200 of it, then that sale was actually only 800, the net sale, right? So that sales returns and allowances reduces our net sales, right? It is the return. So if we say a sales return, that is just like it shows here, the physical return of goods. If we say an allowance, that's a reduction in the price that was owed based on some reason, whether the merchandise was damaged or defective or something like that. So, you know, maybe it was damaged in shipping or something. So they're giving us a reduction in the price. Or if we're the seller, we're giving a reduction in the price for some reason. And then credit memo, we'll see this again, our credit memorandum, short for that is credit memo. A written statement indicating the seller's willingness to reduce the amount of the buyer's debt. So we're going to see on this as we look at these journal entries, when a customer returns goods, we're going to debit sales returns and allowances, credit accounts receivable, basically. All right, so here's an example. It says on August 14th, Whitewater Raft Supply sold merchandise on account to Marty's Fly Fishing Adventures, $15.94, and recorded the sale in general journal form. So again, it would have been, you know, a debit to accounts receivable for Marty, $15.94. Credit sales revenue is what this original transaction would have looked like, right? $15.94. So we would have debited accounts receivable, credited sales revenue. And now transaction B, Marty's returning some of it. So it says on September 5th, Marty's Fly Fishing Adventures returned $254 worth of merchandise. So again, we see here the debit to sales returns and allowances for the amount being returned, the credit to accounts receivables. Because now, because Marty returned some of it, he no longer owes us $15.94. He returned $254 worth. So now he only owes us, here, let me get my calculator, $15.94 minus $254. Now he only owes us $1,340, right? Because he owed us $15.94 minus $254. Now he only owes us $1,340. So we reduce that accounts receivable for Marty. We reduce that, we credit that accounts receivable. All right, here's what that looks like on, again, that basic accounting equation, these T accounts. So this was the initial sale, debit to accounts receivable, credit to sales revenue. That was the initial sale. And then here's the return, debit to sales returns and allowances, credit to accounts receivables, credit to AR. All right, sales transactions involving sales tax. So, you know, if we go to the store, whether it's whatever, Walmart or Walgreens or, you know, whatever, and we buy something that is, you know, has $100 price tag, we're not just paying $100 even, we have to pay the $100 plus sales tax, right? And so just like the, you know, that we've gotten experience with in our personal lives, let's say that sales tax is 8%. So we'd have to pay $108 is what Walmart would collect from us, right? $100 of that is Walmart's revenue. The $8 is the sales tax that has to be paid to the state. So that's what we're looking at here. So sales transactions involving sales tax, when the customer owes the amount of the sale plus the applicable sales tax. Retailer collects sales tax and then later pays it to the tax authorities. In our case, like the Missouri Department of Revenue, right? Sales tax payable account records the amount of the sales tax computed and included for each transaction. So what happens with these, and we're gonna see an example of it, but we're gonna end up, you know, basically, however the customer pays. If they pay cash, we'd end up debiting cash. Let's say we're gonna debit cash. We're gonna credit sales tax payable. We're going to credit sales revenue. And so, you know, again, just to make the math easy on me, let's say that it was for $100 item and sales tax is 8%. That means that sales tax would be $8, right? So if we're assuming sales tax percent, let's just say sales tax 8%, then we would take our $100 sale times 8%, which would mean that our sales tax is $8, right? So then cash would be 108, sales tax payable would be 8, and revenue would be 100, right? Something to that effect. All right, so here's our example of it. It says retail store David Fly Fishing Outfitters had the following transaction, which includes sales tax computed on the amount of the sale of the merchandise. January 3rd, sold merchandise on account to R. Martinez, invoice number 101, $153.50 plus sales tax of $12.28. So again, we have to add these two numbers, 153.5 plus the sales tax, $12.28, means that we have to, or Martinez is going to owe 165.78. Right? And that's what we see here. So we're debiting accounts receivable for the total amount, crediting, and I wish they would just call this revenue, crediting sales revenue for the sticker price, basically, and then crediting sales tax payable for the amount of sales tax. And what happens is that periodically a company, whatever they owe, let's, you know, this is 1228. Let's just say this was the only sales tax transaction they had. They would turn around and they would pay this 1228. They would pay to Department of Revenue for the state. So for us, Missouri Department of Revenue, right? That sales tax. The merchandising company collects the sales tax, but then they have to turn around and pay that to the Department of Revenue. All right, sales returns involving sales tax. So, you know, along those same lines as looking at the sales returns and allowances, when a customer returns something, if they paid sales tax on it, then that sales tax payable will get reduced as well, right? So on this one, it says, on May 1st, David Fly Fishing Outfitters sold merchandise on account to B Hill 1550 plus 124 sales tax. On May 5th, B Hill returned the merchandise and David Fly Fishing Outfitters issued the credit memo. So you see the debit to sales returns and allowances, the debit to sales tax payable, and the credit to accounts receivable. Not too bad, but anyway, we'll get some practice with them. All right, accounts receivable ledger. So, you know, we mentioned earlier kind of the difference between this controlling account and then the subsidiary ledger. The subsidiary ledger has all of the customers that owe us money. So all credit customers are listed in the subsidiary ledger. And if we add up all of those customers that owe us money in the subsidiary ledger, that adds up to the controlling account. So the controlling account is like the one that would appear, for example, on the balance sheet, right? We would have the total amount of accounts receivable on the balance sheet. But again, that total amount of accounts receivable is made up of several credit customer accounts, right? So if we've got 10 customers that owe us money, those 10 customers will add up to the total in the controlling account, right? And so just like it shows here, balance in the accounts receivable account should equal the total of all credit customers' individual account balances. And then in a computerized, where we're using accounting software, these transactions are automatically posted to both the subsidiary ledger and the controlling account as well. All right, so this shows us an example of this, thinking about that general journal. And this is if we're, if we're recording our transactions manually, this is how that, you know, we would have to do it. But it gives you an idea of what's happening kind of behind the scenes of the accounting software is, you know, this is kind of our main sale. And again, this main sale would have to be posted both into the main accounts receivable account 113, and then also the accounts receivable subsidiary account for Mesa River. So this account number 113, this is the main control account. And then this one down here, this is the subsidiary ledger account. Right? So each one of the customers that owe us money would have this subsidiary, one of these subsidiary ledger accounts. All of those subsidiary ledger accounts added together equal the general ledger or the control account. Ooh, wrong way. All right, here's an example of that schedule of accounts receivable. Again, we get this information from subsidiary accounts receivable accounts. Oh boy, I could spell. Right, we get those balances, and then this balance will match the total in AR, the total in the accounts receivable control account. All right. This kind of shows how they all link together. Again, these are our subsidiary accounts. We add all those together. They make up our schedule of accounts receivables. And then that ending balance in accounts receivable, schedule of accounts receivable would match our ending balance in our main control account, our main accounts receivable account. Okay, purchase transactions. So, you know, we're going to see a couple new accounts with these. Again, we've gotten practice before with transactions similar to this, but now we're going to look at purchase returns and allowances. So a new account that we haven't got practice with before, but the purchases account is used to record the cost of merchandise bought for resale. Considered an expense and has a normal debit balance. And some of the source documents related to purchases are the purchase request or purchase requisition, the purchase order, and then also an invoice that is sent by the seller. Here's an example of the invoice. We're going to talk more about these terms and get into this a little bit more in chapter 10 as well, but 2/10 N/30, that means that if Whitewater, so, you know, this is the seller, Pataponia, this is the buyer, Whitewater. And so if Whitewater pays within 10 days, they get a 2% discount. Right? 2/10 N/30 means that if the buyer pays the amount due within 10 days, they will receive a 2% discount. Otherwise, the entire amount or the net amount is due in 30 days. So we say 2/10 N/30. And now it's showing us the total down here. So the unit price, there were 12 of them. So 12 times 142.50, the total amount of the sale plus freight, total amount of the invoice. All right, so now they're going to show us some of these purchase transactions on the next couple slides. You know, again, we've gotten some practice with these before, if, you know, whether we have been purchasing assets or paying an expense, you know, we're debiting the asset or debiting the expense, crediting accounts payable, right? If we're not paying cash. So August 2nd, bought merchandise on account from Pataponia, 1710, terms 2/10 N/30. Freight prepaid and added to the invoice, $85.50. So this is the total. Bought merchandise on account from Langseth and Son, invoice number 982, 2,772. Terms net 30 days, dated August 8th. Freight prepaid and added to the invoice 157. So what we're going to end up doing on all of these, and we'll see this on the next slide, is that we're going to debit we're going to debit purchases for this amount. All right, debit purchases for this amount. We're going to debit freight in, our freight charges. We're going to debit freight in for that amount. We're going to credit AP for this amount is what's going to end up happening on these. Excuse me. Bought merchandise on account from Dana Manufacturing Company, 564, terms 2/10 N/30, dated August 15th. Freight paid by the seller. Bought merchandise on account from Pataponia, 250370. Freight prepaid and added to the invoice 10230. So again, we'll look at these examples. So on this one, we're debiting purchase, we're debiting freight in, and again, you see the credit here to accounts payable for the total amount due, right? Because we owe for the purchase and for the freight in. Then you see the same thing down here, debit purchases, debit freight in, and then the credit to accounts payable for the total amount due. Here's the next two transactions. Again, this one on the 17th, this didn't have any freight, right? No freight charges. The seller paid the freight. So we're just debiting purchases, crediting accounts payable. And then on the 26th, debit purchase, credit, or excuse me, debit freight in, credit accounts payable. So anyway, we'll get some practice with those. All right, purchase returns and allowances accounts. So similar to that, sales returns and allowances, purchase returns and allowances reduce the amount of purchases. So, if we had purchases of 1,000 and then we return some of it, say $100, then that'd be purchases of 900, right? So purchase returns and allowances is a contra or an opposite account to purchases. So it's a deduction from purchases. And so if we think about, we take our total purchases minus purchase returns, that gives us, net purchases, similar to what we saw with the sales returns and allowances. All right, so here's our example of that. It says on September 2nd, bought merchandise on account from Dana Manufacturing Company, 830. On September 8th, Whitewater Raft Supply returned some merchandise and received a credit memo, 1629 from Dana Manufacturing Company. So originally, when we bought this merchandise, we would have debited purchases and we would have credited accounts payable, right? But now we're returning some of it, to $270 worth. So you see Dana Manufacturing's returning some of it. So you see the $270 return here. So now we're doing the opposite to AP. We're debiting accounts payable, crediting purchase returns and allowances, right? So here's the debit to accounts payable, credit to purchase returns and allowances. All right, freight charges. We looked at some examples of freight charges. You know, depending on the, you know, the shipping agreement, either the buyer can pay the shipping cost or the seller can pay the shipping cost. And so FOB destination is when the seller pays the shipping cost. So terms, FOB destination terms if the seller assumes the entire cost of transportation. So seller pays shipping cost. Okay. And FOB shipping point, the buyer pays the shipping cost. So the buyer is responsible for paying the freight cost. All right. I know we do have a multiple choice question on the exam that we need to know the difference between these. So FOB destination seller pays the shipping cost. FOB shipping point buyer pays the shipping cost. All right, so we see that here too. You know, again, FOB destination, seller pays the cost of transportation. So ownership is not transferred until the goods are actually delivered to the buyer, right? Because the seller paid the shipping cost, the seller has ownership of the goods until they're at their destination, until they have been delivered, basically. And so FOB shipping point, the buyer pays the shipping cost. The buyer is responsible for the transportation cost. So the buyer assumes over ownership once it's in transit, once it's being shipped. All right, so here's an example of this one, and we saw this already. This is where we purchased the merchandise from Pataponia, and it's showing here how we handle freight in. We saw this actually a few slides ago already. So it says bought merchandise on account from Pataponia Inc. invoice 2706, $1,710, terms 2/10 in/30, dated July 31st. Freight prepaid and added to the invoice $85.50. So again, we're going to have to pay Pataponia the total amount. Both of these added together is our accounts payable, right? Not only the amount of the purchases, but the freight as well. All right, you know, similar to what we saw with the accounts receivable, control account, ledger account, the accounts receivable subsidiary ledger accounts, the schedule of accounts receivable. We have that same thing with the accounts payable accounts as well. So if we think about as a business, all the companies that we owe money to, right? Each one of those, let's say we owe five, you know, five different companies money, right? So all five of those creditors, all five of those people that we owe money to, would make up our total accounts payable account, right? And so that's what it's showing here. Accounts payable ledger. The subsidiary ledger consists of individual accounts for all of the creditors. These are all the people we owe money. All people / companies we owe. We owe money to, right? Those are our liabilities, right? Accounts payable liability. Balance of the accounts payable account should equal the total of all the creditors' individual account balances when all postings are up to date. So again, just like we had with accounts receivable. So you think about, here's our accounts payable control account, and the balance in there, and I use the example of 5, so I'll just do 5. You know, this is a sub account, 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 this is a sub account. These are 5 creditors. 5 creditors, or like I put up here, people we owe. Oh gosh, I spelled that wrong. Okay, anyway. So each one of these are a sub account, right? So these sub accounts add together to get the total amount that we owe, our AP control account. All right, so we see that schedule of accounts payable here. Again, that balance in the schedule of accounts payable should match the balance in our control account, our general ledger control account. And these, in this general ledger control account, again, this is made up of these 3 sub accounts. Those are the subsidiary ledger accounts. All right, internal control of purchases, you know, just like we looked at with, you know, in chapter 7 and chapter 8, when we talked about payroll and we talked about some of the different things with internal control that we can do. Kind of the main internal control that we always think about is the separation of duties, you know, and that's kind of what they're showing us here. So, for example, purchases are made only after proper authorization is given. Purchase requisitions and purchase orders are pre-numbered, so each form can be accounted for. Receiving department checks all goods upon receipt for count, damages, and description. Receives a copy of the purchase order without quantities listed. Report of the receiving department is verified against the purchase order and purchase invoice. Payments authorizer is neither the person doing the ordering nor the person writing the check. Again, this is what we talked about before and what is always talked about with internal control is separation of duties. Separation of duties. Authorized only after the purchase invoice data are verified against the receiving report and purchase order. Writer of the check is not involved in any of the foregoing purchasing procedures, right? Again, separation of duties. Okay. All right, so these are a few of the practice exercises that I had picked out for us. We don't have too much time left because I'm trying to keep this, you know, about as long as a class would be, but let's go ahead and just take a look at a few of these quick ones together. They won't take us too long to do. Hi there, everybody. Okay, let's see here. I wish I could see. Oh, let's see. Okay, chapter 9 exercises. And again, these are all periodic inventory system is what we're focusing on first, right? So this is 9-1. This one says sold merchandise on account to D North, $2,515.25. So again, we would debit accounts receivable for this D North, 25, 15, 25. Credit sales revenue, 25, 15, 25 is what that one would look like. Sold merchandise on account to Next Star, 775. Debit accounts receivable for Next Star, 775. Credit sales revenue. I know in your book it just calls it sales, but we've been used to using revenue, and I think it's good to just make sure we know that that's our revenue, right? We're selling merchandise, we're selling products, we're selling goods. Letter C, Next Star returned $225.50 worth of merchandise. So they owed us right here, they owed us $775, right? But now they're returning $225.50 worth. So we're going to debit sales returns and allowances. Sales returns / allowances 225.50. We're going to credit accounts receivable for this Next Star 225.50. And so if we think about it, they owed us $775, but then they returned $225.50. So now, and let me do this on our calculator, 775 minus 225.50. 549.50 is all they owe us now, right? All right, let's look at exercise 9-3. So this one, record the following transactions in general journal form. Sold merchandise on account to A. Bauer 680 plus 500, or excuse me, plus $54.40 sales tax. So we've got to add these two, 680 plus 54.40 and 680 plus 54.4, 734.40, 734.40. And so this is going to be debit accounts receivable for Bauer, 734.40, credit sales tax payable for the amount of sales tax, 54.40, credit sales revenue. For what, 680 is what that one would look like. Letter B, Bauer returned $105.50 of the merchandise, applicable sales tax $8.44. So this one would be debit sales returns and allowances. For the amount of the merchandise, $105.50. Debit sales tax payable, applicable sales tax $8.44. And then credit accounts receivable for this person, since they're returning some of this. What's the total amount here? 105.5 plus 8.44, 113.94. So again, if we're thinking about how much this person owes us now, they owed us 734.40. And then they returned some goods, and we subtracted 113.94. So now they're down to 734.4 minus 113.94. They're down to owing us $620.46. Okay, exercise 9-4, journalize the following transactions in general journal form. Letter A, bought merchandise on account from Brewer Inc., $914, terms in/30, net amount due in 30, FOB destination. So this doesn't have any shipping cost in this example, right? FOB destination means the seller paid the shipping cost. All right, so bought merchandise on account. So on this one, we purchased merchandise. So we're debiting purchases, 914, crediting accounts payable for this person we owe, Brewer, or this company that we owe, Brewer. All right. And then letter B, received a credit memo from Brewer for merchandise returned. So now we are returning some of this, right? So we bought 914 worth of merchandise. Now we're returning some of this. So when we purchased this merchandise, we owed $914. And so now that we're returning some of it, we have to reduce accounts payable. So we're going to debit accounts payable. Remember, accounts payable decreases with the debit. So now we're decreasing what we owe Bauer. 238, and we're crediting purchase returns and allowances. Purchase returns and allowances. 238. Okay, you know, again, thinking about how much we owe. Oh, it's Brewer, not Bauer. Whatever it is. Thinking about how much we owe. So we owed them $914. Then we returned 238 worth of merchandise. So now that accounts payable would show that we only owe 676 to Brewer. Okay, one more. Exercise 9-6, record the following transactions in general journal form from Ford Education Outfitters and Romero textbooks. So we're basically doing this from two sides, right? We're doing it from, you know, essentially from the Ford side. The Ford is the buyer, Romero is the seller. So I am going to add a few things between here. Okay, so we're going to have, you know, again, some journal entries for Ford and some journal entries for Romero for each one of these, right? So record the following transactions in general journal form for Ford Outfitters and Romero textbooks. So letter A, Ford bought merchandise on account from Romero 1875.34, terms N/30, which means the net amount is due in 30 days, and it's FOB destination. So Romero paid the shipping cost, right? And so for this one, for Ford to record this transaction, they would debit purchases, 1875.34. They would credit accounts payable for Romero. Now we owe Romero, or Ford owes Romero $1,875.34, right? So this would be from Ford's side. And maybe I should have wrote that. Let's see here. Ford. Okay, now Romero, if they're recording this on their side, this is, you know, Ford, it was a purchase. For Romero, it's a sale, right? So for Romero, Romero would debit accounts receivable for Ford. And so Ford is going to owe them now $1875.34. And they would credit sales revenue, $1875.34. But then Romero also paid the delivery expense. So then Romero would also have a debit for delivery expense. $93.80, credit cash, $93.80. Right? So it's just looking at the transaction from Ford, the buyer, and Romero, the seller, right? Okay, and then letter B, Ford received credit memo from Romero for merchandise returned, $135.78. So Ford initially purchased $1,875 worth of merchandise. Now they're returning some of it. So they credited accounts payable for Romero. Now we've got to reduce that. Ford has to reduce that. So again, coming from Ford's perspective, they would debit accounts payable for Romero, 135.78. Credit purchase purchase returns and allowances. Oof, I'm writing really big. is what Ford's side of the transaction would be, right? And then Romero would record this as, so Romero was the seller. So Romero would record this as a sales return, right? So then they would debit sales returns and allowances, 135.78, credit accounts receivable for Ford, 135.78. All right, so anyway, it was just looking at these transactions both from the buyer's perspective. So Ford was the buyer and Romero was the seller. So just looking at the transactions from the buyer and the seller. Okay, anyway, hopefully that was helpful. We'll get more practice with it in class together. Hi there, everybody. And yeah, so this was, like I said, had to do with the periodic inventory system. And so I'm going to do one more of these for chapter 9 for the perpetual inventory system, because the names of the accounts that we use with the perpetual system are a little bit different. So anyway, as always, let me know if you guys have any questions, and I will see you in class. Bye-bye. All right, what am I doing?